Hey, it's Jeremy here answering your questions about what are call options. I think I've found the best way to explain call options to someone and how they could potentially make money for a trader. Options are just confusing enough to keep a lot of people from working with them, but they're also just easy enough that the retail trader who isn't an expert can get through the minor discomfort of learning what they are and potentially gain greatly from this understanding. And this video should do that for you. And it would help our channel if you would hit the like button. Now, imagine you only have $1,000 to invest and you're looking at a stock like Apple, which has a share price of around $150. And you think to yourself, the most you can buy is about 6 shares of this stock. If the stock goes up by $1 and I own 6 shares, I've made $6. Whoop-de-doo. Now, what if I told you you could rent 100 shares of Apple using that same $1,000 and get the same profits you would get as if you owned 100 shares? Then if the price went up by $5, you would make $500, just as if you paid $15,000 for 100 shares. Now, even though that's not what is happening, that's conceptually a way to look at call options. It's like renting 100 shares from someone and getting the profit or loss that occurs during that time you're renting it. Now, of course, if the price dropped by $5, you would also have lost $500. So you put that $1,000 in and the price changes by $5, you gain or lose $500, just like if you owned 100 shares. Now, if you happen to have a great deal of certainty that the price was going to go up, then call options could be your winning lottery ticket, the golden goose, the royal flush, nothing but net. But what is a call option really? It's a reservation on buying someone's stock. Hey buddy, set aside those 100 shares for me for the next couple weeks and reserve them for me to buy at a fixed price. Here's $1,000 for the contract that guarantees that. Okay, sign here, great, thanks. And that's what a call option is. But let's make it make sense. And don't forget to reserve other simple and fun explanations like this one by subscribing to this channel. What ends up happening is that because the price of the reserved shares is fixed, then the real-time market price of that stock goes up, then the value of the contract you're holding goes way up as well. Because now you have the ability to buy these 100 shares for so much less than they are currently worth. Instant value. It's like having a contract to buy a Mercedes for $20,000 and then it turns out that the Mercedes is now worth $50,000, but you're still guaranteed the $20,000 price. Well, the contract that guarantees that would inherently be worth $30,000. Inherently. It's about right here that the people who hated school start saying, call options aren't for me, there's too much math. Wait. I can guarantee that if you can get through understanding this little bit of math, then call options will be a breeze for you. Now, let's clear up 2 individual words here. Call means to ask to receive something. If a bank calls a loan, they are asking to receive payment for the loan. The word option means granting someone the choice to buy. Reserving those 100 shares for you means that you have the option, the exclusive choice to buy them, and you can call for them. You have the option to call the shares to you for the price that was promised. And this is all part of the contract. There's always 3 elements to a call option contract. There's the price that you agree that the shares can be bought at. This is called the strike price. There's the expiry date. This is the date that the contract expires and is worthless. Anytime between now and the expiry date, the holder of the contract can buy those shares from the shareholder who sold the option contract for the stated strike price. The third thing is that each one contract represents 100 shares. But most of the time, the way call options work is the person buys the contract when the share price of the stock is at $150 per share. The share price of the stock goes up to $151 per share, and the person sells the call option contract for about $100 more than he paid for it. If he only paid $500 for that contract and he sold it for $600, he just made a 20% profit because $100 profit with $500 invested is 20% profit. In essence, you're playing hot potato with the call option contract. Yeah, maybe someone somewhere down the line decides to exercise the contract and buy the shares connected with it for the existing strike price. But most of the time, they just expire worthless after trading hands throughout their lifespan, which is often only a week or two. In summary, a call option is a contract for a reservation for a specific price of 100 shares over a stated period of time. It gives the holder of the contract the right to buy those 100 shares for the stated strike price anytime he or she wants to between now and the stated expiry. In reality though, it ends up acting like you're just renting someone's 100 shares for a short period of time that you hold the contract. So the interpreted definition of a call option contract is you rent someone's shares by paying for the contract, the price changes and you sell the contract for higher or lower than you paid for it. And the general formula is that you will get a similar price change as if you had 100 shares of that stock. Now, when you go to buy these contracts in your brokerage, you are asked to choose an expiry date. Perhaps you choose one that is a week away. Then you are asked to choose a strike price. Many ask, how do I know which strike price is the right to choose? The answer is it doesn't really matter. If you choose a strike price that is close to the existing price of the stock, you will get almost the same results. The point is that if the price changes up or down after you buy the contract, you will get the approximate profit or loss connected with owning 100 shares of that stock, no matter which strike price you choose. It kind of doesn't matter which strike price you choose unless it's too far in one direction from the existing price. There are many other details about these elements that you will learn as you play with these. Trying to teach you those in this video would be too much detailed information. The whole point of this video is simplicity and conceptual understanding of the call option. When you are ready for this more detailed data, check out my video entitled Full Explanation of Call Options. Now, hit the subscribe button for more clear and fun explanations. In my 20-minute trader system, we generally hold a call option contract for less than 2 minutes. We predict a jump in the stock and we buy a call option contract for, let us say, $1,000. 30 seconds later, the price of the stock jumps up by 45 cents and we sell the $1,000 contract for about $1,045. We have now made 4.5% on that contract because 4.5% of 1,000 is $45. If you did that with 3 contracts, you would have made $135 using $3,000 for the investment. Doing that daily for 10 days, that is $1,350 with only $3,000 invested. That's some good money. Of course, usually at least one of those days will be a losing day, so the overall profit and loss wouldn't be as spectacular as 10 straight wins, but could still be pretty awesome. Now, while no gains are guaranteed, the above description of how 20-minute traders' experience goes is not a fake example. Experts have examined and declared such accounts to be real upon inspection of such claims. Far from typical, but certainly it does happen. Subscribe for more clear and fun explanations. And if you want a full explanation of my 20-minute trader technique, hit the link below. It's the technique I use every single day, and I make an average of thousands of dollars a week using it. I hope that helps you understand call options better and how they have been or can be used.